Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 17th of December. I'm Daniel Lam, your host for the podcast. In our 2025 outlook, we have upgraded global equities to overweight within level 1 asset classes. Positive economic growth, supported by both monetary policy, i.e. interest rate cuts, and fiscal policy, i.e. Trump's policy proposals, bodes well for corporate earnings. Now, elevated valuations are likely to limit multiple expansion, while investor positioning risk may create short-term volatility. But we do believe earnings growth can still drive total returns, enable equities to outperform cash and bonds in 2025. Our quantitative stock bond model supports this. It is overweight equities despite weaker data in recent months. Now, within equities, we are overweight US equities. The mix of Fed cuts and Trump-supported policies are likely to help US growth to outperform. This, we believe, will translate into superior earnings growth. Technology and communication services sectors remain our opportunistic ideas. Short-term investor positioning may be a risk, but our 3-month technical model stays bullish. Now, on balance, we believe this will result in US equity outperformance relative to global equities, despite the headwind of current starting valuations. Now, what about bonds? Well, that remains a core holding, i.e. neutral. Bonds continue to offer an attractive yield, especially relative to cash. But we do believe a stronger growth outlook, and hence incrementally higher inflation concerns, will limit any drop in yields. Now, within bonds, we're overweight developed market high-yield bonds. Now, this may look odd at a time of tight credit spread, i.e. elevated valuations, but history does show that these valuations can remain high for an extended period, as long as credit quality holds up, as we expect that too in a soft or no lending environment. So this means the higher yield in high-yield bonds is likely to be sufficient to outperform global bonds if bond prices rise only modestly. At the other extreme, we're underweight EM local currency bonds, given less pressure in many EMs to cut rates and higher currency risk, given EM's vulnerability to US tariffs. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.